Okay, good evening, everyone. Thank you so much for joining us today. So, as everyone knows, the Hong Kong market is really starting to pick back up, and it presents a lot of opportunities both in the Chinese market and the Hong Kong market. And we really want to be at the top of that curve. It's a very advantageous situation to be in right now. And as per this very good event that is happening, we also have a very special guest who is joining us for today's webinar. He is actually the head of fixed income for CSOP Management, and he'll be presenting for us the Chinese macro environment right now and some Chinese opportunities that will take place. At the end of it, I'll also be talking about some ETFs that we highly recommend everyone take a look into, as well as some value stocks that our team has come up with. Okay, so without further ado, I would just like to hand over the time to Mr. Bruce Zhang. Mr. Zhang, please.
Yeah, thanks, Terence. Good evening. Today, I'd like to give you an update on China macro. And thanks everyone attending this webinar in the evening. And thanks you're still interested in the China and Hong Kong markets. We give this update because we still see some green shoots in China. So today's deck we'll divide into three parts. In the first part, we try to understand the challenge that China is facing. And in the second part, let's figure out where the opportunities are and the current environment. And the first two parts will take around 20 to 30 minutes. And the third part will be covered by our fellows in Phillip, sharing the Hang Seng or Hang Seng tech-related investment opportunities. So first of all, we need to understand that China is still conducting the economic structural transformation. As shown in the three charts below, China needs to increase their consumption percentage in its GDP to catch up with its major DM peers. And accordingly, the investment contribution in the middle should be lowered. And of course, the China's current investment commitment, together with a bit more friendly external demand, could help China's GDP. But to achieve a more sustainable per annum growth close to 5%, the consumption recovery should be in place. Then it comes to the next question. Is consumers' confidence back? If looking at the saving rate on bottom left, the China's saving rate is still way above its DM peers, indicating the confidence is still weak. But if we read this from a positive perspective, the Chinese people, they still have money in their pockets. So to further boost consumption, the fiscal implementation should accelerate, and some trade-in program would also help. And consumption recovery is also subject to the property sector recovery, as it is the most important asset that Chinese households have and accounts for roughly 30 to 40% of China's GDP growth, both upstream and downstream. As local governments used to rely heavily on the land sales or the land sales revenue, the current property downturn put mounting pressure on the local gov's leverage. And that's why the central government should and has stepped in to conduct the central local debt swap, the equity debt swap, with the help offered by the SOE, and also the local debt extension by the commercial banks. And this could at least avoid some contagion risk. And in order to overcoming the challenges, or in addition to those challenges, China also has ambitions to develop a high quality growth model. And now someone predicts that China's economy will bottom out and rise, while others says that it will continue to decline due to the real estate market. We think it really depends on the expectations set and the sectors they refer to. For example, if you're talking about the property sector, then obviously it takes time to recover. But if you see the service-related consumption, such as the early May holiday spending or so-called revenge spending, the spending pattern is still quite okay, with the both tourist flow and the total spending even better than the 2019 levels, which is a pre-COVID level. And also, when checking some month-over-month data, you may still find some green shoots in China, even for the second home sales. But however, as compared to the year-over-year data, or per capita spending versus the pre-COVID periods, there is still a gap. As a result, the so-called correct situation in China's growth is that China's growth is maturing, with the property being one of the main drags. We should not expect China to continue its fast growth like what it did over the past 40 years. And this pattern also applicable to other major economies, Japan, Europe, in the history. And to achieve a more sustainable, high-quality growth, China has plotted the blueprint even back to 10 years ago. But of course, the fight against the near-term growth pressure, China has been and should be continuing to implement the supportive policies. And the most recent positive development is the relaxation of the housing purchase in Tier 1 and Tier 2 cities. For example, people now are allowed to buy Beijing, the capital city's property outside the fifth rings. And in addition, the urban village reconstruction and the housing trade-in program, which means that the consumers or Chinese the house owners, they can use their old condo or old HDB to replace a new house, a new flat. Of course, they need to pay a little bit more, but this we call them the trade-in program for housing. All these measures should also help the property demand, and both in the primary markets and also in the secondary markets. And most recently, the secondary market sales looks a little bit better, which we believe is definitely a very good sign, because now the local investors or consumers, they truly trust in or believe in the seeing is believing, which means they may only buy a house when they are completed and can be available to the public. And from a monetary policy perspective, on the top right, given the negative spread, between the China and the US, the yield spread, China may have to postpone its more aggressive monetary easing, as defending the renminbi FX is also one of the key priorities. This is because simply let renminbi to depreciate will not help China's exports that much, given the already high export share of China as compared to the world. But further renminbi depreciation could trigger the capital outflow and the so-called instability of the financial market. So Chinese policymakers make it quite clear that they will maintain the renminbi stability while conducting the prudent easing measures in the meantime. We believe this will continue in the near term unless the Fed can finally make a turn. And more strategically, if you look at the top left, if we simply decompose China's development stage into 3 since 1979, and over the first 20 to 22 years, China did leverage its labor cost advantage and successfully joined WTO in 2001. And since then, China is gradually shifting towards a capital-intensive economy in the first 20 years this century. And the Belt and Road Initiative was also launched over the period. And in recent years, China is trying hard to improve its technology, both hard and soft tech, to further upgrade its industry supply chain and consumption. So from this perspective, the technology still represents one of the focused areas in China. And there is also a joke that the sectors which are under the most severe sanction, which definitely are supposed to have the great potential to grow in China. And the measures, and all those measures I mentioned, they provide the large growth potential for Chinese stocks, such as those listed in the Hang Seng Index, and Hang Seng Tech Index, as their valuation is extremely low after past several years declines. But if you look at the right-hand side, their fundamental is still quite resilient in terms of the sales forecast. And taking platform economy and EV-related names as examples, they are well positioned as they would rather benefit from a consumption downgrade because the Chinese consumers may shift their spending pattern, let's say from the walk-in shopping to the online shopping, or instead of buying an oil car or a luxury car, but now they would rather buy a cost-efficient domestic produced electric vehicles. And even from a broad market perspective, the China and Hong Kong stocks finally started to see some inflows in recent weeks, because at the beginning of the year, the flows is mainly from the national team to rescue the market. But in recent weeks, the flow pattern a bit different. It came from the real money or some money from even from the foreign tactical allocations. The core reason for the recent flow into the Hong Kong or China stock market is because of two factors which are not in line or exceed or either miss expectations. And first, China's macro performance in the first quarter, did exceed the market's original pessimistic expectations, and mainly benefiting from the improvements in exports and consumption. And here, at the beginning of this year, we mentioned that China should no longer rely on exports, which is true. But if the global growth picture looks good, then China's export shouldn't be that bad. And even China's exports to the US, the shares may be gradually declining. The China's export shares versus other countries may still be increasing. And part of the reason is because of these Belt and Road initiatives, as I mentioned, and part of the reasons is because of these so-called re-exports. For example, China can firstly export those goods to Southeast Asian countries, and then those countries can re-export those to the global economies or the Western economies. And as for consumptions, of course, we still are waiting. We're still waiting for this big ticket item consumption recovery. But the good part is that at least the catering or the cinema or even the domestic tourism, these service-related consumption can still be a good offsetting factor for now. And second, the US employment and consumption data missed market expectation recently, also raising the uncertainty about the timing of these interest rate cuts. So global funds need to find alternatives, and that's why some fund flows back to China. And additionally, the Chinese regulatory authorities have provided some active policy support, and Hong Kong listed companies also actively engaged in the repurchase to improve the liquidity. And of course, the current and the rebalancing of the funds is still mainly based on the trading orders or tactical orders. For more strategic inflows, we need a continuing recovery of the macro, such as a 2 or 3 consecutive months of improvements. I think this is not only our view, but since we talk a lot, let's say with the sovereign clients or institute clients in the region, they also are pending a more consecutive months of the recovery signs. And high dividend stocks in the current stage can be another opportunity. For example, the Chinese SOE or central SOE with the high dividend features performed quite well last year. Last year is quite bad. I mean, the image is quite bad for China. But last year, even using a US dollar term to measure their performance, they are still in positive territory. And year to date, they also deliver a high single-digit gain for those names, even in US dollar terms. These are thanks to their stable fundamental with a direct government support. For example, the companies in coal and oil sectors are becoming cash cows because of the reduced capex and the scarcity of the resources. And what I want to clarify here is that from a more longer term growth picture, the China definitely will vote for those green energy or the ESG initiatives. But given the current geopolitical tensions and also the supply chain disruptions, there's still a need for those cash cows, for those traditional energy firms to help to support the whole macro economy. And their long-term free cash flow growing has the potential to drive up the dividend payout. And now their dividend payout is at least 5 to 6%. Thus, the Chinese energy companies, also including those energy companies listed in Hong Kong or Hong Kong, have a higher potential for improving the shareholder return and undemanding valuation. They also have undemanding valuation as compared to the US, particularly for those well-known energy stocks. And EV is another interesting opportunities. And different from the chip producers, which are still subject to a lot of sanctions, the EV are subject to much less sanction risk, at least from a technology perspective, as the the requirement in EVs is not super high. So the Chinese domestic producers can easily handle the production. And also from a market penetration perspective, it is no longer a comparison of engine like the oil cars, but rather the comparison of the EV battery. And the Chinese EV battery producers are also leading the way, so providing another advantage. And more interestingly, EVs are benefiting from these domestic substitution initiatives. We have talking about these terms from time to time since the beginning of last year. This is because China could ask the public sectors or government entities at different levels to purchase the Chinese domestic EV and also encourage the private sector to provide a similar support. And in fact, these domestic acceptance is quite healthy and natural because the young generation are really embracing for those cars. And now all those EV cars also start to increase their market share in the globally, in particular in the Southeast Asia. In Singapore, we have the BYD as one out of taxi model. And in Malaysia and in Thailand, we also see more and more usage of the Chinese domestic EVs. And in summary, on the back of the high for longer environment, investors should be cautious when the turning point of the Fed fund rate finally arrives, as it may also imply the turning point of the US growth and US inflation. In other words, the Fed cut may not necessarily benefit global financial market if at the time the US stocks are also declining with a weaker macro growth picture in the United States. But if that happens, the US, from a as a location perspective, the US Treasury bonds, particularly for long-term bonds, can be a good hedge. But for the equity side, if China's growth is back on track, it could be a chance to return to China shares more strategically. So I'll pause here to hand over to the guys in Phillip to talk more about the Hang Seng or Hang Seng tech related opportunities. Thanks.
Well, so let's take a short break now. Okay, just a quick short break to just digest on all the information that Mr. Zhang has shared with us. Okay, in this time, as a short little break, it was a very information heavy start to our webinar. Okay, I would like to introduce everyone to our Poems Mobile Tree communities. Uh, to our Points Mobile Tree communities. So if you would like an app that has many like-minded investors, a lot of information sharing that goes on, and stay up to date with our staff postings as well, then I highly recommend that you join our communities today. For a start, you don't even need to have a Poems account to view and post in our communities, although I highly recommend opening an account with us. We'll get to that later. But some of the things that we offer here, just a little bit of a sneak peek. Okay, we have US earnings, we have growth stock market updates, even technical analysis, all available for free. The three people that you see here are actually our research analysts They post very, very often inside our P3 communities as well. So you can see we post in growth. We have a community called Growth Stock Picks where we talk a lot about high growth, high value stocks that are going on. We have a technical analysis community as well, where Zane, he's our resident technical analyst. He posts quite often and even answers, even gives technical analysis basically for free to some of our community members as and when he's able to see it. And we also give US earnings releases. So if you would like to have all this for free, okay, as well as have a pretty good trading app as well, you can scan the QR code here and download our app to join our communities today. If you're an existing user, the QR should take you directly to our communities tab, and you can just join up from there and take a look and see. Okay, I'm just going to pause here for about 5 seconds. If you would like to just take a look at our bonus model trader, you can just create a free account, explore the communities, and find out a little bit more about what we have. Then you can just scan this QR code and it will take you directly there. Okay, and let's say you, while we're talking about communities, we actually have a global markets Telegram channel as well, where we post Asian market updates. Recently, with the Hong Kong market starting to climb, Chinese market starting to climb, and a lot of news going on, a lot of fundamentals that are taking place, we also post pretty often on our Telegram channel. It's actually run by myself and my team. Okay, we have Asian market updates, US market updates, ETF news, all available for free on our Telegram channel. You can just scan this QR code and it will take you directly there. Just gonna do a quick pause. This is our Telegram channel once again. Global Investments by Phillip. Okay. If you would like, if all this sounds pretty good to you, and you would like another free channel, it's more information. Just scan this QR code and it'll take you right there. Okay. So let's dive right into it. Today, I have three very simple agendas. Okay, firstly, I would like to talk about some Hong Kong focused ETFs, okay, listed on the Hong Kong Exchange, with a bit more focus on 3037.HK, the Hang Seng Index, okay, and a little bit of 3033.HK, the Hang Seng Tech Index. Next, we will touch quickly on the benefits of investing directly in stocks or investing in ETFs. And lastly, we'll go through some Hong Kong value stocks that my team has come up with, and we feel that it's worth your time to learn more about. Okay, so let's begin with the CSOP Hang Seng Index ETF 3037.HK. Okay, I would like to introduce everyone this ETF. Is a convenient and efficient way to gain exposure to the Hong Kong stock market and reap the benefits of the performance of the Hang Seng Index. As you know, the Hang Seng Index has been pretty much on a downtrend, but now it's really starting to pick up. If you really want exposure, you really want to track the index, this is one of those ETFs that we recommend that you take a look into. But for a start, let me just give you some information about it. Okay, so the stock code is 3037.HK. What it tracks is the HSI Net Total Return Index. I'll talk about a little bit more about that later. Okay, there are 82 holdings in this ETF. Okay, it has an AUM of roughly about, quite impressive AUM of roughly about 1.45 billion, and with a very low management fee of only 0.1% per annum and a quarterly rebalancing frequency. Okay, the performance thus far, year to date of this ETF is 10.88%, roughly 10.88%. And we are all looking at what seems to be the comeback of the Hong Kong Chinese stocks. So you invested at the start of the year, as you can see on the chart over here, in Jan of this year. Okay, you'll be looking at approximately 10.9% in profits. Okay, so just to touch on a little bit more about this ETF as well. Okay, if you're wondering what it comprises of, okay, what is the basket like? Why does it track? How does it track the index so accurately? Okay, the ETF is largely dominated by the financial sector. It comprises of a third of its entire weightage, followed by communications with 21.4% and consumer discretionary with about 17.8%. So the financial sector is largely comprised of banks, insurance, and asset management firms. Some key companies include HSBC, I'm sure we all know that, AIA, and China Construction Bank, which we will touch on later as well. Okay, the communication sector comprises of companies that provide telco services, wireless communications, internet services, and some key companies are Meituan and China Mobile. And consumer discretionary sector consists of companies that provide retail, automotive, leisure and entertainment, and consumer durables such as Alibaba, a very, very popular counter as well, BYD and JD.com. So as you can see on the right side here, the top 20 holdings of 3037 are heavily weighted in industry leaders and stable companies. This provides good exposure to the Hang Seng Index by holding a portfolio of constituent stocks that mirror the index very, very closely. Okay, It has about 12-month yield about 3.73%. This is the dividend distribution history. Okay, it's a semi-annual payment. The latest dividend per share is actually 0.58 Hong Kong dollars. But I don't want to touch so much on this one. Okay, so again, one more time, 3037, CSOP Hang Seng Index ETF. Okay, closely tracking the Hang Seng Index. Okay, so now I'm going to move on to the CSOP Hang Seng Tech Index ETF. This is 3033.HK. So just some key information about the fund. Okay, you can find it under 3033.HK. There are 30 holdings in this ETF with a impressive AUM of 33 billion Hong Kong dollars and also a very low management fee of 0.99% per annum and a quarterly rebalancing frequency. This should be quite familiar. It's the same as closely related to 3037. Okay, so let's look at the performance in the past month. Okay, so it delivered a return of 13.4%, which closely tracked the Hang Seng Tech Index, and its 3-month return is 23.3%. Again, this mirrors the index very, very closely. While there have been fluctuations and a long downtrend since its inception in August 2020, the year-to-date suggests that we might be re-entering a positive trend again with a 4.5% increase. Okay, so again, one more time, 3037.HK, the CSOP Hang Seng Index ETF to get exposure into Hong Kong stocks, as well as 3033.HK, CSOP Hang Seng Tech Index ETF, okay, to get exposure into the Hang Seng Tech Index. If you're looking for an easy way to diversify your portfolio, a simple, straightforward way to get exposure into the Hang Seng Index and Hang Seng Tech Index, it is worthwhile to take a look into these two ETFs as well. Okay, so now I just want to provide a simple overview of several ETFs that focus on the Hong Kong market. Okay, like the Tracker Fund and then again CSOP Hang Seng Index ETF. Okay, so if you're looking for market exposure, cost efficiency, or even dividend yields, excuse me, there should be an option amongst all these to meet your needs. I also want to add that the underlying index column, earlier on you saw HSI Net Total Return Index. Okay, so this basically reflects the price performance plus the net amount of all the dividends if reinvested. So by accounting for the constituents' price movements and the dividends as well, this provides a more comprehensive measure of the overall performance of the constituent stocks. Okay, so briefly, let's talk about some stocks versus some ETFs. Okay, owning a stock in a successful company, of course, can lead to significant gains. Especially investing in the long term, you have greater control over your portfolio, choosing companies you believe will perform well. However, with these upsides, you will be bearing higher risks in the event that the company performs poorly. And there's also less diversification and exposure to company-specific risks. And a single bad company can hurt your portfolio. But for ETFs, like the two that we have just gone through, okay, it offers instant diversification with one single purchase, and it spreads your investment across multiple companies and reduces risk. So because they're diversified, ETFs are generally considered less risky than individual stocks. However, while offering lower risks, they typically can have potentially lower returns. And what's best for you depends on your investment goals and your risk tolerance as well. Okay. But if you are like, now that you see the Chinese market and the Hong Kong market really starting to pick up, again, one more time, I cannot highly recommend checking out and deciding for yourself 3033 and 3037.HK to get your portfolio exposed to the market while it's fresh and hot again. So let's move on to some value stocks that my team has come up with. Okay, firstly, we have China Construction Bank 939.HK. So I just want to highlight some key strengths of 939. First, 939 has a strong balance sheet and with a stable source of funding. It's got a good deposit base, and only a small portion of its funding comes from interbank liabilities. This is one of the lowest in the sector and it ensures stability. Next, they have one of the strongest capital positions among their peers, and this strong capital position gives it a solid foundation for growth and resilience against market fluctuations. In terms of asset quality, China Construction Bank is showing signs of stabilization with improving provision levels. This means that the bank is effectively managing its assets and maintaining healthy financials. Okay, 939 also has relatively low exposure to shadow banking. More on that later. Okay, this however reduces its regulatory risk and enhances its overall financial stability. So in summary, for this China Construction Bank, a strong balance sheet, a solid capital position, improving asset quality, and low shadow banking exposure make it a reliable institution in this sector, the financial sector. Also, to add on a little bit, shadow banking normally refers to financial intermediaries that participate in the creation of credit but are not subjected to regulatory oversight. And some examples are hedge funds, private equity funds, but it can also refer to unregulated activities by regulated institutions, which includes product like credit default swaps. So okay, moving on. Before we move on, we want to compare a little bit to the peers in the financial sector. We can see below China Construction Bank actually has a lower price book ratio 0.4 with a pretty attractive 8% 12-month dividend yield as well. Okay, and a pretty modest year-to-date return of 12%. So one of the value stocks that is worth considering as well. Okay, next we have China Mobile from the communication sector. Firstly, they offer an attractive dividend yield of approximately 7%, backed by a clear 3-year dividend plan as well. So this provides investors with a kind of a reliable income stream. They also have an ongoing Hong Kong share buyback program. So this initiative actually reflects on their commitment to enhancing shareholder value and confidence in their growth prospects. And lastly, China Mobile is actually considered the most defensive in the sector. According to JP Morgan, they have the best defensiveness against market fluctuations, making them a stable and secure investment choice. And their ROE actually compared to some of the peers and compared to the index is actually 9.9. It's actually higher. And the 12-month dividend yield is also an attractive 6.7% as well, as you can see from the bottom. Okay, so I don't want to hang on too long here. We're just going to move on. Okay, in consumer discretionary, we have Chow Tai Fook, a brand I'm sure a lot of us are very familiar with. Okay, 1929.hk. So firstly, there has been a much stronger than expected demand for gold investments in late 2023. Okay, this surge in interest indicates a growing appetite for gold as an investment asset, which bodes well for this industry, of course. Secondly, there has been a stronger than expected margin expansion. So this indicates improved profitability and efficiency within Chow Tai Fook's operations, which is for us a positive indicator of their financial performance. Lastly, they have this line of products, I believe is called Wonderful Life Jewelry. So the penetration of this Wonderful Life Jewelry collection into the lower tier cities has been a lot quicker than expected according to what they reported. And this accelerated market reach suggests that their products are resonating well with a very broad or broader audience, potentially driving further growth and market share as well. Okay, let's move on to the last value stock pick from the team. Okay, we have CNOOC from the energy sector, 883.HK. Firstly, they have excellent cost control. Their upstream operations have a break-even cost control of around $30 per BOE, which is barrel of oil equivalent, which is actually best in class. They also have a strong production growth, with their oil and gas production expected to grow at a 6 to 7% rate annually through 2026, making it one of the highest growth rates globally as estimated by JP Morgan. They also have projects in Guyana and Brazil, and these projects are delivering high returns, contributing significantly to their overall profitability. Okay, lastly, on the topic of dividends, they yield consistent and strong dividend payouts that provide good returns for shareholders as well. So that is actually the 4 value stocks that I wanted to mention in today's webinar. Okay, so let us move on now to the Q&A session. So if you take a look I want to direct everyone's attention to the bottom of your screen. If you're mobile or you're on your laptop or you're on your computer, at the bottom of the screen, you should see a Q&A section. If you, let's say you have any questions, you can key it into the Q&A section, and Mr. Zhang will slowly sift through and see which questions we are able to answer for you. Okay, if you have any questions, now is the time to place them in the Q&A session. We're just going to give a minute, everyone, slowly digest everything that Mr. Zhang has went through earlier, and we'll be waiting for your questions below.
Yeah, I already saw two questions when we present, so I can start to answer those two. And for the people who are still in the call, feel free to ask. You can either chat or through the Q&A tab in the Zoom. So one question is that what's the dividend of Hong Kong stock index? I think for Hang Seng index, it's close to 4, roughly 3.8, 3.9% for now, for in terms of the expected dividend yield. And CSOP's ETF dividend also similar to these versus benchmark, because we more or less replicate the underlying benchmark. And another question is what's the difference between 3033 versus 3067? And I would say both are are listed in Hong Kong, tracking the Hang Seng Tech Index. But in most cases, we won't say others is bad, but we just want to highlight why our 3033 is good. I want to highlight 3 points. First is about the size. The 3033 has a size of over $4 billion, which is the world's largest ETF tracking the Hang Seng Tech Index. And second, our ETF 3033 has the most largest trading volume. So on average, each day, the daily trade, the trading volume on exchange can be as high as 100 million, and sometimes can be up to 500 million per day, which means even institutional clients, they trade our ETF on exchange, there'll be no issue for 2 ways, both in and out. And lastly, is I think it's more relevant to every individual investors. This is because of our size, scale, and liquidity, it translates into a much narrower beta spread. And for those investors frequently buy and sell, for example, buy low, sell high, buy low, sell high, these will be save a lot for investor trading the Hang Seng Tech Index ETF. Because sometimes when we talk about the management fee, it's an annualized concept. But when we talk about the trading cost, it will be a one-off. When you trade in or trade out, there will be exact the fees you will incur. So that's why this can save a lot for investors when using the 3033. And Mr. Zhang, do you think Hang Seng Index moving up is sustainable? That's a really good question. I think in my deck, we do highlight there are some green shoots, but for now, again, the flow pattern are still mainly driven by the tactical flows. But the positive part is that those flows is better than the simple, the pure national teams flow, which means at least even they're tactical, they have a real demand to bet on the rebound, particularly given that China sees some just green shoots of the recovery, and also because the US start to see some mixed or even weak data releases, and which also indicating a less hawkish Fed or even a more dovish Fed. So from this perspective, we think the Hang Seng Index every time when they including the Hang Seng Tech Index, every time when there's a sell-off, there's always a tactical opportunities to buy low and in the future sell high. This is because valuation is quite low, earnings not as bad as the macro picture indicates. But if you really want to see a more sustainable recovery, let's say recover to 3 years, the levels 3 years ago, even recover to the previous peak, then definitely we need more evidence, such as more sustainable recovery of the China macro. And the good news is that not in addition to those green shoots in the macro releases, the policy implementation seems to also accelerate. And if this kind of this kind of implementation can continue till this the third plenary, which will be held in July. And during those sessions, it will announce more pro-growth policies. Then it will be definitely a positive sign for more sustainable recovery of these Hang Seng Index, including the Hang Seng Tech Index. Does Mr. Zhang imply even if green shoots appears in China equities, if interest rates start to go down and US equity also go down at the same time, global equity will also affect it? Yeah, that's a really good question, because everyone wants want to see a very dovish Fed or an interest rate cut. I think all else equal, if the Fed going to cut, it's definitely good. Let's say this will help the equity price discount factors, and also help gradually help lower some of these funding costs in the middle term. But what I want to highlight here is that if the Fed suddenly start to cut very aggressively, this means there must be something wrong in terms of the behind of the US macro. If that happens, then this means the global macro or US macro may have some issues. And if that happens, and given the relatively low correlation between China and US macro, and also if China can effectively implement their growth support policies, then it is a good time to strategically thinking about investing in China versus US. I think that's what I mean in the deck. And what's your review on BABA, given that it has dropped a fair bit recently following earnings? It still has a good stock to buy. As an ETF manager, we typically don't comment any single stock name. But generally speaking, the platform economies in China, we think there's still a lot of room to go. This is because now when we talk about tech firms or talk about the tech sectors, actually most of them are closely linked to China's consumption. And now that China's are still facing some challenges, this may rather benefit the platform economics, because this is a more cost-efficient platform for investors or consumers to trade. And more importantly, if China can find a way to rebalance their supply and demand of the property sector, then it means Chinese public, they may be willing to spending more, because again, given us 40-50% saving rate in China, Chinese people still have money, but now given their very depressed property value, they'd rather not spend that much. But if they are comfortable with their property value, then I do believe there will be more and more spending on the platform economies, and of course can benefit BABA or other names. And 7200, 7266 that are leveraged to a better investment. Well, I would say it really depends. It depends on the investor's risk appetite, because leverage products means more opportunities, but it may also means more risks. Simply from my personal view, if you really have a high conviction of the future direction of this, let's say the Hang Seng Index or even the Nasdaq Index, you may place some, but you need to control your exposure in your total portfolio, because once again, in terms of a balanced allocation or more strategic allocation, you have some core equities like Hang Seng Index or Hang Seng Tech Index for growth part, Hang Seng Index for value stocks, and you may also put some US Treasury for the bond portion, and for the very high risk portion, you may place a relatively small portion. This means you can still harvest some growth potential, but the risk is well under control.
Okay, thank you, Mr. Zhang, for the very informative Q&A session as well. Last chance, anyone will take one more question if anyone will put it in. In the meantime, you can get in touch with us. Okay, here at Phillip. Also, one more thing, we have a short survey that we'd like people to take part in. Okay, it helps us improve. It helps us know what topics that our audiences are interested in as well. So you can actually scan. I know I have a lot of QR codes, but you can scan this QR code to take this survey. Let us know how we do. Let us know what you want to see next. Let us know basically what subjects do you feel like is something that you want to hear more about. Okay, so I'm just going to leave this up here for a while. Okay, so if you have maybe a minute, it actually takes less than a minute. You can actually just scan this and get along with the survey. Okay, just gonna move. Okay, before we get to the opening an account, currently in the theme of Hong Kong stocks, okay, in the view of the Chinese market also picking up, we actually have a promotion that is taking place right now. Okay, here, if you're a Poems client, you're definitely eligible for this as well. Let me just share this for a quick moment. Just give me a moment. Yes. Okay. So we actually have, if you invest in Hong Kong stocks with Poems, we actually have a lucky draw that is taking place at the end of July. Okay, so basically the prizes include a round trip to Hong Kong for 2 or 1 night stay in Shangri-La Sentosa, as well as a mystery gift from Chow Tai Fook, which we talked about a little bit of earlier. We've got vouchers by Xiaomi, we've got vouchers from Samsonite and Hai Di Lao as well. All you have to do is take part in basically trade in the Hong Kong market through Poems, and you basically stand a chance to win. We have lots and lots of information available, including this webinar. The replay will be up really soon on our YouTube channel. It will also be on this page. Okay, so just want to let everyone know that if you trade Hong Kong stocks through Poems now, you actually stand a chance to win all these great prizes as well. Okay, enough of the promotions. Let me just go quickly back.
Yeah, there's one question about how regulated is the solar panel situation. Instead of directly answering this question, I think for a lot of China sectors, let's say the EVs or new energies, they really has a oversupply issue. I think that's something that we need to consider about. Sometimes if you read some headlines, there are says, okay, China is oversupply this, oversupply that, and impact the global financial markets, let's say the regime. But what if it's simply because China could produce a lot of such panels or a lot of such cars, which are more competitive features and also a cheaper price? But if that happens, why there is oversupply? It's just because it will impact the global competitors' business. Yeah. So from this perspective, it's more about the competitions between China and the Western. So instead of saying that there's an oversupply, I'd rather say that now it's more about whether the Chinese market share can be gained or can be accepted by the global markets. It's not only in ASEAN markets, but also in the Europe and US markets.